Welcome to Daily Digests for July 30th, 2026. Today brought a dramatic clearing event across U.S. equities. Before the opening bell, a major forced liquidation hit the semiconductor sector after a high-profile thematic hedge fund unwound its public equity positions. At the same time, second-quarter earnings from cloud giants Amazon and Microsoft delivered concrete proof of enterprise AI monetization, creating a sharp divergence across mega-cap tech. The pre-market volatility centered on Situational Awareness LP, the hedge fund founded by former OpenAI researcher Leopold Aschenbrenner. After building a portfolio heavily concentrated in AI hardware, with reported leverage of up to 4x, the July downturn in semiconductor names triggered severe margin calls from prime brokers Goldman Sachs and JPMorgan Chase. To meet these demands, the fund was forced to offload its public equity book before the opening bell, reducing its assets under management while preserving its private stake in Anthropic. The counterparty acquiring the entire public equity portfolio in a pre-market block trade was Citadel. This single transaction absorbed the overhang of forced selling but had weighed on semiconductor stocks for days. Once the market realized the liquidation was complete and positioning was cleared, chip names staged an abrupt intraday reversal, turning early losses into strong gains across the sector. Underpinning today's market recovery was Amazon's second-quarter earnings report. Amazon Web Services revenue accelerated to 37% year-over-year growth, reaching $42.2 billion. This represents the fastest growth rate for AWS in 18 quarters. CEO Andy Jassy highlighted that both its AI services and custom silicon divisions have surpassed a $25 billion annualized revenue run rate, providing direct evidence that enterprise AI workloads are generating substantial cash flow. To support this demand, Amazon raised its 2026 capital expenditure outlook to $220 billion, up from $200 billion earlier this year. Management noted that even with this record outlay in data centers, power infrastructure, and custom chips, available cloud capacity remains insufficient to satisfy customer demand for 2026 and 2027, reassuring investors that capital spend is tied to committed revenue. Microsoft also delivered strong cloud metrics, with Azure revenue growing 43% year-over-year in constant currency, beating market consensus of 40%. Commercial backlog expanded to $678 billion, demonstrating that enterprise commitments to Microsoft's cloud ecosystem remain robust despite broader macro uncertainty. Investors also got clarity on Microsoft's capital allocation. Management confirmed that a reported $15 billion reduction in full-year capital expenditure guidance was not a reduction in physical infrastructure investments, but rather an accounting adjustment. Microsoft extended the estimated useful life of its data centers and buildings from 15 years to 25 years, reducing annual depreciation charges and shifting certain lease classifications without slowing compute expansion. In contrast, Meta Platforms experienced market pressure, falling 9% after raising the lower end of its full-year CapEx guidance to $130 billion. Because Meta relies heavily on advertising revenue rather than direct cloud infrastructure billing to monetize its AI investments, Wall Street continues to hold a higher bar for Meta's capital spending commitments. Consumer hardware also faced margin headwinds. Apple reported Q2 net sales of $109.4 billion, slightly exceeding estimates, but noted that gross margins on Mac and iPad lines are absorbing pressure from elevated DRAM and NAND memory component costs, as memory suppliers prioritize high-bandwidth memory for AI data centers. From a technical standpoint, broad equity indices are navigating systematic fund levels. The S&P 500 tested short-term CTA sell triggers near 74.55 today. Analysts estimate that systematic trend-following strategies could trigger $31 billion to $184 billion in automated selling if key support levels fail to hold, adding mechanical volatility to intraday trading. In fixed income, the bond market continued to digest yesterday's Federal Reserve rate decision. While the Fed held the target rate unchanged, the 9-3 vote included 3 dissents from regional Fed presidents favoring an immediate rate hike. Long-term Treasury yields experienced a 13 basis point twist steepening as investors reprice inflation persistence and fiscal debt supply. Stepping back, today's price action highlights a transition from speculative position unwinds to fundamental cash flow execution. The forced pre-market liquidation of paper leverage cleared technical resistance, allowing strong earnings metrics from AWS and Azure to reestablish investor confidence in core enterprise AI growth. Looking into August, active investors should track whether the S&P 500 holds above key CTA trigger levels, monitor upcoming 10Q SEC filings for detailed cloud margin metrics, and evaluate how memory price inflation impacts broader hardware supply chains. Thank you for listening to Daily Digests.